Well, hello. We are at the final set of notes dealing with the broad topic of inflation, and today our principal focus is going to be on the costs of inflation. Reading is the final section in chapter 12. So again, this is our broad outline of where we've been. This is what we're going to be doing today. And to give a little bit of more detail to it, what we're going to do is to begin with the definition of money, which seems kind of weird to be in week 5 of an economics class and talking about money. But of course, what you should realize is that the crux of economics is about making decisions when our choices are limited by the constraints that we face. And so money greases the wheels for making those choices, but it's not really what the crux of economics is about. Nonetheless, here we are. We're going to talk about the definition of money, link that to the value of money, and then in turn link that to inflation. And then we'll talk about what the functions of money are and offer a summarization as to how inflation affects the value of money. Then with that, we'll use that to think about how so what we're going to observe, not surprisingly, is that when we have inflation, that's something that's going to erode the value of money. So this is what we think of as imposing costs on society as a result of inflation. So our question is, how are those costs going to manifest? So we're going to make a distinction between two possibilities. One is that inflation is correctly anticipated. So for instance, we think the rate of inflation is going to be 3%. A year goes by and inflation is 3%. That would be an example of correctly or fully anticipating inflation. But there are some additional costs that arise when inflation is unanticipated. We'll talk very briefly about hyperinflation and kind of a rule of thumb known as the rule of 70, and then speak a little bit, just one slide, about deflation. So, in terms of thinking about our broader objective of what are the costs associated with inflation, what I want to do is begin with a definition of money. So, money is any sort of asset that's regularly used in transactions. So, we'll see partly in what we do today and then later on in the semester that assets that serve the role of money as being money in an economy have to fulfill some special roles or functions. So we'll talk about those functions today, and we'll continue to think about them in subsequent lectures, a little bit more towards the end of the semester. The one thing that I want to do just in terms of kind of more or less an aside at this point is that there are some things that we commonly think of as money, like debit cards and credit cards, and maybe even our Venmo account, that are not strictly speaking money. So debit and credit cards, and paying somebody by Venmo are substitutes for money. And then similarly, there are things that we generally don't think of as being money that in fact are. And so, if you were really, really interested in what kinds of things are counted in various measures of money, you could follow that hyperlink. It's purely optional, not something I'm going to quiz on, not something that you need to know for this semester. But essentially, what the definition of money turns on is this question of transactions. And so our focus is going to be on very liquid monetary assets. That means we're going to be looking at the assets that are most readily accepted in day-to-day transactions. So when we consider what we mean by that, now we're going to be talking about coins and paper currency and checking account deposits. This is how I'm going to be thinking about money in this context or in this set of notes today. If you follow the hyperlink, what you'll see is that as we consider alternative definitions of money, what we're doing is including assets that um, um, are less well suited to serving is in day-to-day transactions. So, again, if you're interested in that, you can see that. If you're interested in a course that deals with this, it's Econ 335, Money and Banking. That's a course that's offered in the spring semester this coming spring, and is very interesting in terms of drilling into both what is money and then more insights with monetary policy. For us, what I want to do is think about why money has value. And as should be evident, I was also thinking about candy and Halloween. I really like this time of year because I love chocolate and I love these little fun-sized bars. And so I was thinking about those. And so that's the reason for our example. So money's value, my basic assertion here is money's value comes from its ability to be used in transactions or to buy stuff. And by stuff, I mean goods or services, either today or at some point in the future. So for our example, again, we're going to be using little candy bars. Let's suppose, just for sake of illustration, that each candy bar has a price of 25 cents per bar and that you have $1. So what can you do with your dollar if you're going to devote it to the purchase of candy bars? Using our higher order math skills, we can readily see that you could get 4 candy bars, 4 of these fun-sized candy bars. And so what does that mean more seriously? What that means is that the value of your $1 in terms of candy bars is 4 candy bars. And then, quite obviously, if the price of candy bars rises to 50 cents per candy bar, then the value of your $1 is going to decline to 2 candy bars. So the value of your dollar is a reflection of its real purchasing power. How many goods, in this case, or more broadly, goods and services, can you purchase? In terms of thinking about this from the perspective of the equation that allows us to think about this from a macroeconomic context, we can note that by way of summarizing what we had before, of course, the value of your $1 when candy bars, when the price is 25 cents a candy bar, is 4. So you get 4 candy bars per $1. And so again, 4 candy bars per $1. So how could we rewrite that? Well, we could rewrite that as 1 divided by $0.25 per candy bar. If you flip the denominator, you're going to get candy bars divided by 0.25 or 1/4, and that would give us what we had before. So what is this? Well, of course, this is the price of a candy bar. And so we can say that the value of your $1 is 1 over the price of a candy bar. In other words, the value of your $1 is inversely related to the price, in this case of candy bars. And then to continue with what we saw in the previous slide, obviously, when the price rises, then the value of holding $1 goes down, or in other words, its purchasing power declines. So putting real in here is in fact redundant. When we say purchasing power in economics, we're talking about the ability to purchase physical goods and services. So it is real or inflation adjusted. So let's bring this out to the perspective of the macroeconomy. In the macroeconomy, what's the value of $1? Well, the value of $1 in a more general sense is equal to the overall real set of goods and services that you can buy with $1. So rather than thinking specifically about how many candy bars can you buy, we're going to think about what is the value of $1 in terms of all the stuff you can buy. And so what we would say is that the value of the dollar of $1 is 1 over its overall average price level. And we'll actually see this come into play when we talk about exchange rate determination a little bit later. But so just sort of hold on to that thought. But so what is the overall average price level? Our notation for that was a P, and we could be thinking about, say, a consumer price index or a deflator. Again, this is one of those instances in which we don't need to be specific about precisely which measure of the average price level we're using. We're just saying we're going to use an average price level. And so that again, we have the basic conclusion that as the average price level rises, in other words, as we have inflation in the macroeconomy, the value of money declines. And this is bad in a pejorative sense, in a normative sense, because we think of money performing several important functions in the economy, and precisely three of functions. So if the value of money is declining, then this is going to be the same thing as saying that we're worse off because money is less successful in coordinating our economic behavior. So what I want to think about at this point is what are these three functions of money? And then later on, how does that play into the problem of inflation? So when we think about money, an asset that's going to serve the role of money needs to be one that performs each of these three functions. It doesn't need to do each of these three functions equally well, but it needs to perform these three functions. So what is the first of these functions? The first of these functions is that money, an asset that's going to serve the role of money, like cash, is going to serve as a medium of exchange. And a medium of exchange is just a fancy pants way for saying that you can use this thing to make transactions. So just think for a minute about how your standard of living would be different, presumably lower, a lot lower, if you couldn't make transactions at all. Then you would have to rely strictly on the sorts of things that you could gather and make yourself, or perhaps you could make transactions, but you had to barter for them. In other words, you had to find somebody who wanted the thing that you were selling, or maybe string together several people who all collectively could barter so that you could achieve the good or service that you wanted. I think about myself and I just go, yikes, who wants to, as you're doing this, listen to econ video talk chats? Not so many people. And so I'm lucky that in the broad marketplace, there's money with which I can go out and buy goods and services because it would be harder for me to walk around, uh, downtown St. Louis or Clayton and say, "Who wants an econ lecture? I'd like a cup of coffee." So, in other words, what we're saying money does is it solves the problem of having to find a double coincidence of wants. In other words, if I want a cup of coffee, I have to find somebody who's selling coffee and at the same time wants to hear me talk about the functions of money. Having money in an economy allows us to transcend that. A second function of money is that it serves as a unit of account. And this is to say that money is the common unit that we use to measure economic value. And I think focusing on this word of measure is particularly helpful. So when I was learning this, I used to think about this as a ruler or tape measure, that you were literally measuring out, like a tape measure would measure distance, that a dollar or a unit of currency is measuring out a particular value. And so this is something that's important because, of course, we have talked about economic decision making involving comparing marginal benefit and marginal cost to the associated prices in the marketplace. So we need to have a price that's conveying for us in a well understood way economic value. And then the final thing that an asset, a final function that an asset needs to fulfill if it's going to serve the role of money, is that it needs to be a store of value. So, in other words, we talked when we were talking about money as a medium of exchange, that it made it easier for us to consume today instead of having to rely on barter, for instance. When we think about the store of value thing, uh, money that can be stored where its value is preserved allows people to consume at some point in the future. So we would save today, and we would be able to consume then from those savings in the future. So if we think about, just the natural life cycle. You tend to be working as you're in your 20s, 30s, 40s, 50s, and maybe 60s so that you can retire. And at that point, you don't have, say, a wage based income. But if you've saved during those working years, then that generates for you an income that allows you to continue to consume at a level that you desire. This idea is what's known as consumption smoothing, and it's something that we'll take up when we talk about consumption overall in chapter 13, probably towards the middle of next week. So, when we think about the store of value function of assets, it's why historically we think about gold, for instance, as serving as money, but we don't generally think about bananas. So, bananas, of course, they're pretty good when they sit on your counter for a little while, but after a few days, they get sort of mushy, and after a lot longer than that, they really aren't used or usable in the same way that they would have been even a week earlier. So we don't think about money or that bananas serve the role of money. Because they fail to serve as a useful store of value. Even if we could use bananas today to trade goods and services, and even if we could express prices in terms of some standardized banana unit, bananas fail as a generalization on this store of value measure, and so we wouldn't think of them as serving properly the role of money. So the important thing with an understanding of these functions of money is the understanding. So right now I'm just asserting it, and on the next slide we'll explain the idea that inflation is a problem because it undermines the productive benefit of having or using money in a macroeconomy. In other words, it undermines the ability of an asset that we're calling money to serve these three roles. And again, we said money is useful because it allows us to save, to consume in future periods, to specialize in terms of goods and services so we don't have to produce everything ourselves, and so forth. So, uh, what can we say about money as a medium of exchange? Well, money can only be effective as a medium of exchange if it's widely accepted. And that wide acceptance is going to depend upon, say, the recipient of, of money, say cash for sake of discussion right now, having basically faith that when they accept the money today, they'll later be able to use it to buy other goods and services at reasonable prices. When inflation is a problem, it's not clear that the money that they accept today will maintain its purchasing power. Similarly, we talked about money serving this role of being a unit of account. The value of money needs to be relatively stable in order for it to be a reliable unit of account, right? So if we think about just a tape measure or a yardstick, um, that's useful to us because the increments in an inch and a foot and a yard and so forth aren't changing. But if prices are changing, then of course the value of money is changing. Prices go up, the value of money is going down, and it's not as useful for us as a reliable unit of account. It's as if one day we said a foot is 12 inches, and the next day we said, oh, JK, a foot is only 8. And then the day after that we said, still JKing even more, a foot is 15 inches. So that variability of prices means that we're not having a well understood measure of value in the economy. And then finally, as a store of value, money is going to successfully function as a store of value when it can reliably hold its value over time. But of course, again, if it is the case that inflation is changing the value of money, then by definition, right there, it's not reliably or predictably holding its value over time. So, what I'd like to do is to begin to think about how inflation imposes costs on society. So, in other words, the flip side of this would be, why do we care about inflation as a problem or something that we want to potentially address with macroeconomic stabilization policies, particularly monetary policy, as we'll talk about it later this semester. And again, the idea here is that we think about inflation imposing costs on societies. And why? Because inflation undermines the productive benefit of money. Inflation, imposes costs. So these costs arise because money isn't able to perform its functions well when we have inflation in the macroeconomy. The higher the rate of inflation, of course, the less well money is able to perform its functions, and the extreme case of this that's described in the textbook would be hyperinflation, and we'll have a little bit more to say about this towards the end of these notes. So it's important to recognize that costs associated with inflation are going to exist even if inflation is correctly anticipated. And what do we mean by that? Again, what we mean is that if the rate of inflation that people expect is the rate of inflation that actually materializes. So again, this is expected inflation. And then the pi without the e superscript is just the actual or realized rate of inflation. And then importantly, societies face additional costs when inflation isn't correctly anticipated. And by not correctly anticipated, what that means is people form some expectation of inflation, but of course, that isn't the one that turns out to be realized. So what we're going to do is we're going to consider this aspect first, and then we'll consider the next after that. So there are two costs that I want to identify associated with inflation that are going to arise even if inflation is fully and correctly anticipated. And this is probably one of the few places in economics where we have colorful narrative kind of descriptive language. So menu costs and shoe leather costs. Um, Menu costs are the idea that got its name because an economist was looking at, of all things, I think it was actually in a Chinese restaurant, a menu where the prices on the menu had either been scribbled out or maybe there was a little sticker put over them, and the economist started wondering, like, why would they do that? Why wouldn't they just, you know, print a new menu? And of course, the explanation for that is that it's costly to make those price changes. And many of us are so used to buying goods and services online that we think, oh, what is that? It's one day the price is one thing, one day the price is another. That doesn't cost anything. But of course, that's false. There are real people behind the scenes, both coding as well as making the decisions about what prices should be, and it does take real resources in order to make a decision about what prices should be, and therefore when prices need to change, there are real resources that are being used in that endeavor. So it's still the case these days that even though a lot of our buying and selling happens in an online environment, that there are, of course, literally menus are printed, catalogs are still printed, supply sheets are still printed in a business setting. And so there are lots of instances in which we could think quite literally about there being costs associated with printing new price lists. So these menu costs are going to arise because inflation renders money as an unstable unit of count. Prices are marked, say, for example, in the US, in US dollars, but because of inflation from one year to the next, those dollars are going to be worth less. And so last year's price isn't suitable this year. And as I said earlier, businesses have to devote valuable resources to these kinds of price adjustments. And there's a real cost. Those resources, in principle, could have been used to producing a tangible good or service, but instead they're used in this particular manner. Shoe leather costs is our other sort of creative description of the impact of inflation on the macroeconomy. And the idea here is that if you are holding cash in your pocket and there is inflation, what that means is that one day you would, let's say you have $10 in your pocket, you can buy $10 worth of goods and services. But if prices are rising, then a year later, let's suppose prices rise by oh, I don't know, 10%, you would need to have not $10, but $10.10 in order to buy what you could have bought with $10 before. And so the purchasing power of money is going down. In an effort to reduce the loss of value associated with holding money, particularly cash, but we could also think about checking account deposits to some extent, people have to take measures to keep their wealth in other assets. The idea of shoe leather costs itself was particularly ascribed to the example of countries that were experiencing very high rates of inflation. So literally, you wouldn't want to hold cash. You'd want to hold it at least in a bank where you got interest that would hopefully keep up with the rate of inflation. But every time, and it sounds sort of arcane given our reliance on things like Venmo and credit cards and so forth. But in the old days, if you couldn't quite so readily make transactions without having money. And so the idea here would be that you'd have to shuffle off to the bank, get some cash, make your transactions. And the act of shuffling off to the bank to get the cash is wearing down the bottom of your shoes, hence the idea of shoe leather costs. So these are the more generally, of course, that's less of an issue for a country like the United States, where both the rate of inflation is relatively low, and also we have lots of other ways to make transactions besides quite literally having cash. But nonetheless, the idea is legit in that there are still costs that are going to go into people trying to reduce the erosion of the value of their assets. And so shoe leather costs is a description of that. So people have to use resources in order to try to maintain the value of their assets. So shoe leather costs and menu costs are both costs of inflation that will arise with or without perfect understanding of what inflation is. There are two other kinds of costs that are imposed on society that happen particularly when we don't know what the rate of inflation is or is going to be. So, again, when we say inflation is unexpected, it means that we form an expectation of inflation, but we don't know whether that's going to be the one that actually materializes. So, one of these additional costs is the idea that inflation is going to confuse the signals that prices send. And again, this is very important in that even if you go back to the demand and supply notes, remember that we said if there is a change in demand or supply, prices send signals to producers and consumers about how to allocate their resources. When we have changes in prices and we don't know whether that's something unique to, say, a producer, or it's just overall what's happening in the macroeconomy, it can lead to resource misallocation. So, specifically, let's suppose that first, so not this example in which inflation is anticipated. So, let's suppose that you know with certainty that the overall rate of inflation in the macroeconomy is 2%. And you observe, you're a seller, you observe that your firm's output price is rising by 4%. Well, then your reaction is Yippee! People like my stuff a lot more. The price of my stuff is rising more than the overall rate of inflation. That's positive demand shock, and your reaction should be in response to the higher relative price to increase quantity supplied. Prices correctly signaling to you how to allocate resources because you understood what was happening to prices overall. Now, suppose you don't know what's happening to prices overall, and you observe that your firm's output price rises by 4%. Well, you have to say, did all prices rise by 4%? If that's the case, then there's no relative change in the desirability of your firm's product, and you shouldn't allocate any more resources to producing it. Or suppose it was that overall prices were rising by 2% and your price rose by 4%, in which case you should be producing more output. Or suppose it's the case that overall prices rose by 6%, but your output price only rose by 4%. Well, then your stuff is relatively less desirable and you should not be producing any more of it. So the problem when we can't observe with certainty what's happening to the rate of inflation means that it's possible for mistakes about resource allocation to be made. And the reason for this is that we're losing our guidepost of money as a unit of account. And so, therefore, then that instability confounds the signals that prices send. As a additional source of problem here, additional resources might be unproductively devoted to devising ways to avoid inflation's adverse impacts. So, for instance, if inflation pushes people into higher tax brackets, they might try to get, either they devote a lot of their resources to lawyers' fees to figure out how to navigate that, or maybe, do things that are not on the up and up in order to try to avoid a tax burden, for instance. So, just more generally, when inflation cannot be correctly anticipated, there's an incentive for people to try to figure out ways to avoid its consequences. The second additional cost of inflation that happens when inflation is not fully anticipated is this idea that there can be an arbitrary or an unplanned redistribution of income and wealth. And what this turns on is the act of borrowing and lending, which is why we introduced the interest rate discussion in the previous set of notes. So most loans are going to specify repayment schedules in nominal terms. They are, in other words, using money as a unit of account. And so unexpected inflation changes the real value of borrowers' repayments. This is the key idea. And as well, the amount that lenders receive in unanticipated ways. And the result can be, if this happens, one time, it's like, well, bummer. But if we have inflation that's difficult to predict year over year over year, that can mean that resources are allocated persistently in unproductive ways, or in the extreme, you can see financial markets just break down. People are going to say, I can't predict what I'm going to get in inflation adjusted terms as a result of borrowing and lending, and so I'm just not going to do it. And as we will see, financial markets that coordinate savings and investments are going to be integral to improvements in long run, or increases in long run economic growth. And so this can have really adverse consequences for an economy's longer run performance. So to get at this, what I want to do is consider an example. So let's suppose that today, on October 16th, you borrow $100 from me, and you agree to pay me back $105 in a year. Um, so recall from our earlier discussion that the nominal interest rate is the price that you pay per 100. So $5 is 5% of this 100. So we can say that the nominal interest rate is 5%. How did we arrive at that point where we agreed on a 5% nominal interest rate, or that you were going to pay me back $5 in a year. Well, again, let's remember how we thought about the nominal interest rate. So the nominal interest rate, which in our example right now is 5%, we said is comprised of the real risk-free rate plus the expected rate of inflation. And so what we're, again, just as a reminder, we're going to say that there is no risk premium. So that is something that we'll maintain as an assumption for the duration of this course. So we can think about this risk-free rate in this context as, you know, what amount do I need to have in inflation-adjusted terms in order to have me part with this $100? And similarly, what amount are you willing to pay in order to get $100 today in inflation-adjusted terms? So suppose that we agree that you're going to pay me $2 to compensate me for deferring my consumption today. Or in other words, suppose we agree that you're going to pay me $2 so that you can have consumption today. In other words, you're going to get the $100. In that particular case, we're going to think about this risk-free rate as being 2%. And suppose that we think about the rate of inflation, we expect that the rate of inflation is going to be 3% over the year. Then we're going to think about this again, ex ante means before the fact. So remember in the last notes, we talked about the sequencing of interest rates. So we said people think about what this risk-free rate has to be, or this ex ante real interest rate, and they form an expectation of what the rate of inflation is, and together that gives us the nominal interest rate. And then in those notes we said time passes, and then we have a realized real return. That's what we're going to turn to now. So suppose that the rate of inflation is, as we expected, 3% over the year. So in other words, let's suppose that we expected the rate of inflation to be 3% and the rate of inflation was 3%. What does that mean? So what that means is that I need, on average, $103 in order to be able to purchase the same amount of goods and services that I could have purchased today with 100. So again, what is 3% inflation? That is an increase in the overall level of prices in the economy. So overall, prices are rising by 3% means I need $3 more, or $103. Now I receive $105 in nominal terms. I needed 103 to stay even, or to maintain my purchasing power. So again, remember we saw that word phrase earlier in these notes. So maintaining my purchasing power required $103. I get $105. So I have a realized real return of $2, or 2%. So $2 of 100 gives me this 2%. And so this is the increase in my purchasing power, or my real reward. It means that in 2021, I'm able to consume $2 more than what I would be able to have purchased with $100 in 2020 in inflation adjusted terms. And this realized real return, of course, is exactly what I wanted as a compensation for lending to you. And why is that? It's because inflation was correctly anticipated. So again, I want to go back maybe. What did I want? I wanted this extra $2 as a reward for lending to you. And in fact, I get that. Now, what happens if we make a mistake and our expectations are not confirmed? So what if the actual rate of inflation was 4% over the year? So again, we're imagining here that we expect the rate of inflation to be 3%, but in fact, the rate of inflation is 4%. What is the realized real return? And how would we think about this affecting borrowers and lenders? This is today's participation question, and I'll pause while you take a look at that. So what should you have found? You should have found that, excuse me, the realized real interest rate is the 5% nominal return that you get minus the 4% rate of inflation. And so the realized real return is 1%. Now, what does this mean? This means that I, DP, thought she was going to get 2% real return, or an increase in my purchasing power, but I only got a 1%. And you, the borrower, thought you'd have to pay 2%, or in other words, $2 to, borrow. This is again in real terms. But you, the borrower, only pay 1% in real terms. So what does that mean? That means you, the borrower, you're really happy. Borrower you says, yay, and the lender me says, oh man, this blows. I thought I was going to get a 2% real return. I only got a 1% real return. And the reason for that is because inflation turned out to be higher than expected. And so if we think about this, this is the first case that we talked about. This is previous slide. And I encourage you to work this middle case out on your own. So suppose it's the case that that the nominal interest rate is 5%, the expected rate of inflation was 3%, and let's suppose that inflation in fact turned out to be 1%. I would hope that you could convince yourself that the realized real interest rate is bigger than the ex ante real interest rate. So our overall conclusion here is that we see when inflation is different from what was anticipated, then that can lead to an arbitrary redistribution of income and wealth that affects borrowers and lenders in ways that they didn't anticipate. So we would talk about that, or we would think about that in this case as being a misallocation of resources. So if we could have correctly anticipated inflation, we would have allocated our resources differently. And so as a result of this, we think about inflation as being particularly problematic when it's difficult to anticipate. And the whole of these costs just become worse when we have hyperinflation. So what is hyperinflation? You know, extremely high rate. That's not too helpful. Sometimes we think about this as inflation rates in excess of 50% per month. But there's no hard and fast rule of what specific number defines hyperinflation, but something that is extraordinary. So all of the problems of inflation that we talked about, the erosion of the value of money, the consequence that money isn't serving its functions well, and that there are costs that society bears in terms of menu costs, shoe leather costs, misallocation of resources, and these redistribution arbitrary redistribution of income and wealth costs, those all just get magnified when we have hyperinflation. We tend to see countries experiencing hyperinflation often have low levels of investment in physical capital because of the borrowing and lending problem that we just finished talking about, and they often experience recessions. So some of you may choose a country that is experiencing hyperinflation. So Zimbabwe still is less extraordinary than it was. Venezuela is a classic example right now. And there are countries that more recently have experienced hyperinflation that you may choose to do your country study on, which would be interesting for all of us. If we wanted to get a sense of sort of what are we talking about with the problem of inflation generally and hyperinflation in particular, we can apply this sort of rule of thumb known as the rule of 70. And the rule of 70 says, and it's not just confined to inflation, we can apply this as a generalization anytime we know a growth rate. And so we'll see this in some of our subsequent discussion as well. So the rule of 70 says that you can figure out approximately how many years it'll take for something to double if you divide the number 70 by that something. So by its is the something, its annual growth rate. So in this particular example, I picked three levels of inflation that, say, the US has seen in my lifetime. So the rate of inflation in the US has tended to lately kind of hover around this 2% level, a little bit less as of late. In the 1970s and first part of the 1980s in the US, the rate of inflation was 7%, maybe rising to as high as 14%. So just kind of back of the envelope calculation, if the rate of inflation is 2%, that would mean that prices are going to double in about 35 years. So that's like every two generations. That's swift, but if prices were rising at 7%, then they would double in half of a generation, and even less than that in 14 if the rate of inflation was 14%. Now, if you really want to get a sense of the problem of hyperinflation, you can look at these two numbers. So this is the rate of inflation for Zimbabwe, estimated for the current year for 2020, and their inflation is very, very difficult to estimate in Venezuela. So there are lots of different estimates, but this one was one from the IMF. And so this first hyperlink here would take you to the IMF website if you were interested, where I got both of these numbers from. This hyperlink takes you to a podcast that tries to explain in other terms, how do we think about how deep the problem of and tragic the problem of hyperinflation is. So it's one of my favorite recent podcasts, so I would certainly encourage a listen. But if we think about Zimbabwe, oops, I meant for this to be 622. I'll correct it in the notes, 0.8. What we would have is that prices would be doubling approximately just a little bit more than once a month. And that's mind blowing to think about until you think about what the experience is in Venezuela, where prices are doubling perhaps during a week, depending on what estimate you get here. Prices are doubling twice a week, yeah, two times a week approximately, or perhaps even more frequently than that. And that's just astonishing to think about. And if you stop and think about how would your life change, or what kinds of adjustments would you have to make if you saw that prices were doubling that swiftly, it gives you just the smallest of insights into what people in these countries are having to navigate and how tragic it really, really is. So we'll talk a little bit more about the problem of inflation as related to policy when we get into the latter part of the course. So the last thing that I want to think about in this set of notes is deflation. We've talked about all the problems of having rising prices, and so the inclination might be to say, well, falling prices might be what we want, right? Who doesn't want lower prices? But that problem, deflation, is potentially as dangerous or more dangerous for an economy than inflation is. And so the problem of deflation can, I think it's just, for me, this example of buying a car is the one that I always go to, or, substitute in a refrigerator, a dishwasher, whatever. Um, s- Typically something that's durable. So suppose you're considering buying a car, the car is going to be cheaper next year because there is deflation. So deflation means that prices are falling from one year to the next. So the rational person says, well, I'm not going to buy it now. If the price is going to be lower next year, I'm going to make my car sort of a limp along for next year, and then, maybe even limp along again. So you delay purchasing. But if everyone in the macroeconomy does this, then so many purchases are postponed that firms have to lay off workers and stop producing, or stop producing as much, and the economy tips into either sluggish growth or out and out recessions. So this can lead to really dangerous downward spirals. Certainly, it's something that occurred in the U.S. During the Great Depression, and in many other countries during this time period, and Japan recently, 1990s, and even going forward. So this is, I didn't make it clear here, this is U.S. data. Um, of what was happening to the inflation rate. So you can see, inflation rates sort of the order of what we think of, but then profound disinflation excuse me, profound deflation in the macroeconomy during the Great Depression. And then, of course, for the US and for many countries, there was a double dip in the Great Depression, and we saw deflation again. These hyperlinks here and here, they take you to the same place if you're interested. Again, it's a podcast that deals with particularly Japan and its experience with deflation. There were concerns, really significant concerns, that the US would enter a deflationary period as the Great Recession kind of took hold. If you were interested, you could go back and Google, deflation, Great Recession, and see what kinds of things pop up. We had a very brief period of deflation, but it didn't persist. And so the problems the extraordinary problems, say, experienced by Japan from the 1990s until more or less the present, and the US and many other countries during the Great Depression, didn't occur, obviously, for the US in our more recent recession. So, with that, we conclude our discussion of inflation. I'll go back just to keep this up here. Next up, next week, for week 6, we're going to embark on two things. One is talking about the other kind of big macroeconomic variable, and that's unemployment, and then other related labor market indicators. And then the other thing that we'll turn to is the issue of consumption. So we're going to talk at length about consumption and investment, because they will help us think about the development of the model that we're going to use to describe the macroeconomy over the business cycle. So we'll dig into those two things. But for now, this concludes what we need for week 5, and I wish you the best going into the weekend, and we'll check in at the start of next week. Take care. Bye bye.